Okay, so in this video I'm going to walk through the steps required to calculate the potential available equity within a property that we can then go and use to acquire additional property. Hi there, thanks so much for sparing some time to watch this video. My name's Tim. Now, over the past 15 years or so, I've helped hundreds of people acquire property in my role as a property investment advisor and as a property investment educator. One of the things that we have to do as investors, or when we go to acquire property, be it a home to live in or as an investment property, whilst the lender is going to provide funds to cover majority of the costs, there will be some funds that we need to put on the table ourselves. So we'll need some form of capital, be it in the way of equity and or cash. So in this video, I'm going to run through how we can potentially tap into equity within a property. So we're using other people's money, it's on paper money, and that way we can use those funds to cover such things as a deposit and even purchase costs. Okay, so I'm going to bring up a diagram now just to make it a little easier to walk through the steps in this calculation. It's pretty straightforward, but this diagram will make it a lot easier just for you to see and also for me to explain. Okay, so before we start moving into the calculation, I just want to point out that this is not finance advice or financial advice. It's purely just for example purposes only. All right then, so let's have a look. We'll draw a house up here. Now for this purpose, we're going to assume that the value of the property is $500,000. And what we normally do when we're accessing equity in an owner-occupied home is that we'll limit that LVR to 80%. That's just a general rule, doesn't have to be that. So 80% of 500,000 is 400,000. So that's a maximum loan amount that we'll go to against that property. And we're all going to also assume the loan amount, or we have an existing loan against the property of 150,000. So the maximum debt that we can take on against this property or secure against this property is 400,000 at that 80% loan to value ratio. And we do have existing debt of 150,000. So the calculation is simply the 400,000 being the maximum amount, less the 150,000 already owing, equates to 250,000 of available equity, subject to obviously lending criteria, etc. So that 250,000 we can then use for deposits and also closing costs or purchase costs on a property if we choose to. We don't have to use the whole lot, but that's what we would have available to an 80% lend against a $500,000 property. So this is one area of the calculation or process we need to follow to determine whether we are in a position to actually acquire a property. So what we've looked at today is the capital that we may have available. We also need to talk to a qualified professional. In this case, probably a good starting point would be a qualified mortgage broker, just to determine our borrowing capacity as well. So capital and borrowing capacity will then determine the actual potential purchase price of a property, and it'll be subject to lending conditions. Okay, let's assume that we've gone to see our mortgage broker and we're all good to go. We've got access to that full $250,000. Now, as I mentioned earlier, we don't have to access the full $250,000 if we don't feel comfortable in doing that. And I also mentioned that a lot of people limit the LVR or the maximum loan against an owner-occupied property to 80%. So 80% LVR, so 80% of the total value of that property. So let's take one step further. Let's assume we're happy to go out and acquire a property. And for this example, we'll assume that the purchase price is $400,000. So we found a $400,000 investment property that we're looking to acquire. Now, as I say, a lot of investors will go leverage higher against investment properties. So let's assume again for this example that we're going to a 90% loan to value ratio. So that would mean we're going to have to provide a 10% deposit. So 10% of 400,000 is 40,000. Now, we're also going to have to cover the purchase costs, and the purchase costs are typically around about 5% of the purchase price, and the large majority of that purchase cost is stamp duty. So 5% of 400,000 is 20,000. So what we'll do then is we add those two together. So we've got 40,000 being the 10% deposit and 20,000 being the 5% to cover the purchase costs. So total those together, we get $60,000. So we say we've got 250,000 available to us. So 60,000 taken from that 250,000 leaves us with a remaining of $190,000 in that equity that we tapped into. So if we've still got $190,000 available to us and we felt comfortable in acquiring multiple properties, and our borrowing capacity was allowed us to do that, then we could go and use the remainder or the balance of that equity to then fund another property, or however many you feel comfortable with, basically. So the leveraging to a higher LVR against an investment property preserves some of that capital and allows us to acquire additional property if we choose to do so. Well, I hope I didn't lose you doing those calculations. But look, thanks again for watching the video. If you haven't already and you feel happy to, please feel free to subscribe to the channel. That way you'll get notified when I upload new content. And if you like the video, please feel free to hit the like button. That way I'll know the type of content people are looking to watch. So thanks again and all the best.